Looking now at the currency market with Shireen Darmalingam, who is Macroeconomic Strategist at Standard Bank. Morning, Shireen. The US retail sales better than expected, but the markets haven't really responded to that, certainly not in volume terms. And then the GDP numbers from Europe, an average of a 0.2% decline, but of course averages don't mean much when half the countries or some of the countries are still growing, and of course that southern European band are not growing at all and in recession. So the context there for the currency, which weakened a bit this morning to 8.19.
Yes, indeed, David. We did see quite a number of the European economies register negative growth, and the Eurozone as a whole registered growth of negative 0.2%. And taking that into context of what's happened over the past 3 quarters, where we saw no or negative growth, it's not really spelling good news for what we could expect for the remainder of the year. Yes, we did see some of the bigger economies like Germany, for instance, post positive growth, but it wasn't really enough to counteract what we did see coming from the other economies. So we are still wedded to the idea that we could see a recession again in the Eurozone for this year, and we're priced in growth of about negative 0.5% for this year, and we're not expecting to see much growth come from that region next year as well. With regards to the retail sales coming out of the United States, it was a positive number of 0.8% and quite significantly more than the consensus of 0.3%. But we also have to bear in mind that it did come from negative growth of 0.7% the previous month. And while it may indicate this month that consumers are putting a little bit more out there and are emptying their pockets, and possibly an indication that consumer sentiment is picking up, but we need to really see a few more months of positive data to really have some kind of indication that the US consumer is starting to make headway, and that could possibly contribute to better growth in the US economy. So we could still see sluggish growth coming from that US economy as well, and that's really going to put a drag on the currencies going forward if we do continue to see negative growth coming through for both those economies. Yes, we did see the rand weaken a little bit this morning, and it's really attaching to the trend that we're seeing in the euro-dollar movements as well. We do expect the rand, however, to remain within the fairly narrow range that we have seen over the past 5 or 6 days, between about 8.05 to about 8.20. So if we do see negative data, yes, we could see some pressure coming through on the currency again.
One other interesting indicator, and of course there's always that relationship for us with inflation and the strength of the rand and the oil price. All of that feeds in a complex formula which increases or reduces the costs to our economy. Oil up to 113 yesterday, which is around about the 3-month high for oil. And they say there's a mixture of factors feeding in there. One is optimism that they will be easing or that the Eurozone crisis will be sorted out. But on the other hand, there are some supply issues. So any thoughts on the oil price being very strong and in the context of the rand?
It is fairly strong at the moment, but we don't really see much of that pressure coming through from the CPI front. We are seeing transport and petrol prices having come down significantly, so it's not really going to impact the CPI numbers significantly for this year. We currently have a CPI number priced in at 5.5% average for this year, so the pressure on the currency is not going to be as adverse as what it could possibly have been, and it is going to act a little bit as a buffer given the fact that we are seeing inflation fairly positive.